The short-term S&P trend is still down, even if the Fed decided right now to cut interest rates. Today is April 8th, it's the evening, and we have been watching the market decline dramatically in the last week. The cycles are still bearish until the end of April or even mid-May. We were looking at several important cycles. One of them is the 11.5-year cycle, which we've talked about now for a few weeks. And it's basically saying the market goes down again into the late part of April, early May. 3 times that, 34.5 years ago, is the best match. And it's been repeating, as we said in the last video, that 34.5-year cycle in a general way has been working for 20 years. It's been repeating the major swings. And right now it's very, very close in terms of the short term. The daily chart is also highly correlated. So the 1990 market also did say that the market would go down last week as well as this week, even though we were thinking it would go up into the end of the week last time. The short-term cycles were overtaken on Wednesday, and they started down quicker and more dramatically than we thought. And it goes lower, and we are presently probably at the end of the third wave of the decline, and these declines will have 5 waves. And so we have a third wave completing this week. We have a fourth wave which should come in and go up until roughly April 22nd. And then the final 5th wave, which may be big, could take us down into somewhere early to mid-May, probably somewhere around the 12th. It comes out between the 8th and the 12th of May, several different cycles bottom. So time is the primary thing that we consider. And so why did I say if the Fed should cut interest rates, it still wouldn't work? Because the time's not up. Now, if they did do so, what would happen is probably the market would rally in the 4th wave that we expect to start next week and go up for about 10 days and then go down again, So it still wouldn't have the effect that's expected. We do expect that, we have been saying that probably what will happen is the decline being so severe is going to scare the Fed into having to make a decision to lower interest rates more than they would have thought. And then we expect that probably will happen in May. And if it does, it's still not going to have the effect immediately. But by the end of June, early July, we should see an explosive rally to the upside. So the big question is this the beginning of a bear market? Okay. Now it's possible because there are Elliott wave counts, for example, that indicate that the high that came in February was the end of a 5th wave, and that this could be the beginning of a very large decline that will never make a new high before it goes down further. But the reality is there's still a chance, based on the 60-year cycle, which is bullish until August and then again until February of next year, that it's possible the market will go up further. It's also likely, based even upon the short-term cycles, are saying that at least after the low comes in, probably in May, we'll go up into the early part of August minimally. Okay, and then we could go down again into October this year, and it would seem like again we're in trouble. But it's still possible we'd have one more rally into the early part of 2026. 2026 is looking bad. Any way you slice it, we're looking to see a decline that's very severe. Could be 30 to 40% going down into the end of 2026, early 2027. And we have numerous cycles that are including the 60-year cycle and the 1937 market. Again, the 147-week cycle has been repeating for months and months and months. It's been repeating very closely to what's actually happened, and it goes down into the late part of April. The 162-week cycle, which we've been talking about, is 54 weeks times 3. That also goes down into early May. And so until that point, there's a very good chance the momentum is not going to turn. And if the momentum doesn't turn, we could conceivably make new lows as late as May 12th. So what's interesting right now is that multiples of the 11.5-year cycle have been repeating. And also, the 18.6 year, it's a very famous cycle in the commodities market, in the real estate market. It's actually the cycle of the lunar nodes. They have an 18.6 year cycle through the zodiac. And when they get to this particular part of the cycle, every single time you go back, you could go back 100 years, and you'll see that in 2005, the market had a big drop, and it's still repeating very, very closely. And then in 1987, the time before that, the crash in 87 lines up exactly with the February high this year. The low, by the way, was December 9th in 1987, which, if the time swing continues to repeat, the low would come in May, the analog. And then in 1969, you had a huge decline. And then in 1949, you had a big decline. In 1931, you had a big decline in the middle of the massive bear market that took place after the 29 crash. So if you go back through history, this particular phase of the 18-year cycle has repeatedly caused big down moves. This one isn't even as big as some of the others. So where's the low in this thing? Well, one of the things, the price levels that we projected right at the moment are based upon several different factors. One of them is the high in 2022 was roughly in the 4,700 area. And we have our matrix lines on the large scale come out around 4,760. And the Andrews median line technique, which is another way of generating price projections, also comes out around the 4,700 to 4,800 area. And that's a likely place for the market to stop. But given the momentum and given the extreme acceleration that it's had lately, it's conceivable we could break through that and go a little bit lower. I don't expect we're going to see 4,000 or anything lower than that at this time. I think most likely we'll stop within a few hundred points of where we are. Right now we're at 4,950, and then we'll probably bounce. We'll go sideways for a month or two, and then shoot up over the summer, and then we'll see if that high is higher or lower than the present February high. If it is not, then there's a chance the bear market has begun. If that high is tested or broken, then we're probably still in an uptrend, potentially even longer than this year. The big cycles are always going to dominate over the short-term things. So you don't want to rely upon the short-term dates to buy and sell. Particularly, you don't want to be buying this market until it's very likely that the low is in, and the low is very likely not done yet.